America's annuity agent licensed in all 50 states. Today's topic is a very good one, so lean in and listen. The topic is indexed annuity income riders versus deferred income annuities, which are called DIAs. So indexed annuity income riders versus DIAs. Which one is better for future income when you need income to start in the future? Very good question. I'm glad you asked it. I'm glad I'm getting ready to hammer factually the answer. So let's talk about how we do things at the Annuity Man, okay? If you go to our site and you schedule a call, we're going to ask you two questions. What do you want the money to contractually do, and when do you want those contractual guarantees to start? We have an acronym called PIL. That's what annuities solve for contractually. P stands for principal protection, I stands for income for life, L stands for legacy, the other L stands for long-term care / confinement care. So in this case, we're looking at income for life. So if you answered, I want lifetime income, either joint or single life, and I need it to start in 3 years, 5 years, 7 years, and I want to use IRA money or non-IRA money, not sure. You can use a Roth if you want to, but in my perfect world that I live in with six-pack abdomen muscles that I don't have but I wish I did, Roth IRA should be used for real growth products. And when I say real growth, once I put real in front of growth, it eliminates all annuity types regardless of what your agent locally has told you. So which should you buy? The income rider attached to an indexed annuity or deferred income annuity? Let's go through both. Let's go through the positives and negatives, and there's no bad decision. The first thing I would tell you is quote both, and we'll do that for you if you want to, or you can go to my site and do it yourself, theannuityman.com, 24/7, 365, the best calculators on the planet. I would go with the highest number, the highest contractual guaranteed number, but I say that with a caveat because I'm going to explain both products. Let's do the indexed annuity with the income rider. An indexed annuity is a fixed annuity. It was introduced in 1995 to compete with CDs. It is not a market product. It is not a security. It will not get you market returns. I don't care what anybody says to you, shows you, promises you, bad chicken dinner seminar, good steak dinner seminar. I don't care. That's not what they were designed for. They were designed to, index annuities were designed to protect principal and get you CD-type returns, maybe a little bit better if it all worked out. And those accumulation value lock-ins have three levers to limit the upside, which is cap spreads and participation rates. We're not going to go into that because that's not how we use them at the Annuity Man. We use index annuities primarily as an efficient and cost-effective delivery system for the income rider guarantee, that future income stream. So when you go to our site, you can run income rider quotes. So in other words, we're running just the income rider. We're not talking about the index annuity. We're not talking about the accumulation value. We're not talking about cash spreads and participation rates. We're definitely not talking about upfront bonuses, which is candy for the stupid. Remember, there's 100 pennies in the dollar. So when we quote income riders, we're quoting ones with the bonus, without the bonus. It doesn't matter. We're quoting for the highest number. But the good news about income riders is that it's flexible, okay? If you said, okay, Stan, I want to turn on income in 10 years. I want to set it up single life, or you can set it up joint life, either way. But at the end of the 10-year time period, you might say, you know what, things have changed. I don't want to do that. I got this index annuity that's underlying that the rider's attached to. Just send me all the money back from whatever it's grown by on the index annuity. You can do that. It's flexible. Now, riders attached to index annuities have fees. Typically, those fees can range anywhere from 0.75 of a percentage point up to 1.5% annually for the life of the policy, and that fee is taken out of the accumulation value. So when you see the income rider quote, that's a net amount. That's what's going to happen, okay? So index annuities, it's a flexible future income. Flexible meaning if you decide to pivot out of it after the surrender charge of the index annuity, you can get your money back, whatever it's grown by, and typically it's a CD type rate. Deferred income annuities is the uncle of an immediate annuity. Immediate annuity and deferred income annuities, DIAs, are the same structure. No moving parts, no annual fees, no market attachments, okay? It's a straight transfer of risk pension that can be used in IRAs, Roth IRAs, non-IRAs. The difference between a deferred income annuity and an index annuity with a rider in a non-IRA account is the deferred income annuity is going to have some tax preferential treatment of the income because the income is a combination of return of principal plus interest. So non-IRA account, you're only paying taxes on the interest. Now, downside to a deferred income annuity is rigid. I mean, think about the water faucet in the back of your house as a kid. If you rip the knob off that water faucet, water's flowing, period, okay? With deferred income annuities, it's a rigid contract. There's no liquidity, there's no annual fees, but there's no liquidity and you can't pivot out of it. So if you said, okay, Stan, apples to apples, income riders attached to index annuities or deferred income annuities, which one should I choose? We're going to say, do you need it to be flexible? Is there a possibility down the road that you aren't going to need this and you just want to get money back, etc.? Then choose the index annuity with the income rider. If you say, no, I don't want to pay fees, I know this is going to happen, I want to lock it in, period, then a deferred income annuity would work. The other thing you could do is do a combination. So let's just say you say, okay, I'm going to put $200,000 in it, and let's just say they were both close in the quotes, do 101 and 100 in the other. There's no one size fits all. I will tell you, even though commissions are built into all annuity types, the index annuity is going to have typically a higher commission than the deferred income annuity. You don't ever see it. You should be looking at the contractual guarantees of the policy, but that's the difference between the two. One's not better than the other. You should quote them both for lifetime income. And if you're using IRA money, deferred income annuity can then turn into what's called a qualified longevity annuity contract, which is a deferred income annuity used inside of an IRA that has some preferential treatment because the IRS and the Department of the Treasury came out with that product in 2014. Couple more things about index annuity with income riders versus deferred income annuities. DIAs, both are going to pay for as long as you're breathing. Both are lifetime income streams. Both are transfer of risk, that you're transferring the risk to the annuity company to pay as long as you're breathing. Both are going to the income you receive will subtract from the total, and if you outlive your life expectancy, you could get to the point where you're at zero in your account, but the annuity company is still going to pay as long as you're breathing and or on a ventilator. So you can't run return on investment numbers. I always tell people there's no ROI until you die. Up until that point, it's a pure transfer of risk that it's going to pay. It's a pension. So both of these are pension products. Both of these are used for income starting later, which we call income later. If you answer, what do you want the money to contractually do? I need income. When do you want it to start? 5 years, 7 years, 10 years, whatever. That's when we quote both. And then that's when you get on the line with my team and we explain the good, the bad, the benefits, the limitations. There's not an annuity product that's perfect, but just walk away with this. Index annuity, flexible. You can get out at the end of the surrender charge time period of the underlying index annuity and get your money back. But it does have fees for the life of the policy, okay? And then deferred income annuities, very, very simple, easy to understand. You could explain it to a 9-year-old, no offense to 9-year-olds, but it's rigid and there's no liquidity, okay? But both provide lifetime income and both will pay as long as you are breathing. I will encourage you to go to my site, theannuityman.com. I've written annuity owner's manuals on both products, income riders and deferred income annuities. I've also written one on fixed index annuities if you want to understand the underlying product that's delivering the income rider guarantee. I've also done hundreds of videos on both of these topics if you want to dig in even further. And you can run quotes 24/7, 365 without anyone showing up at your doorstep and bothering and calling you. We do not do that. We wait for you to engage with us. With that being said, my name is Stan the Annuity Man. This is the Stan the Annuity Man YouTube video channel, growing by leaps and bounds. See you next time.